Welcome to Market Technology Flex, and in this video we're talking about investing in mid-cap companies' advantages and disadvantages. With investing, the size of a corporation is often measured by its market capitalization, otherwise known as market cap. This metric is equal to the total number of shares outstanding multiplied by the company's current market price. For many investors, market cap is an important factor to consider when making investment decisions. Mid-cap companies are those with a market cap of $2 billion to $10 billion. These companies are usually well-established and have a sound track record, but they are not as large as the mega-cap companies. Many investors view mid-caps as an excellent compromise between small-cap and large-cap stocks. Simply stated, market capitalization is the amount of money it would take to buy all of a firm's shares at the current market price. The actual process of acquiring all of a firm's shares is more challenging than it appears, and it must be accomplished under government rules and various sorts of closing costs. In addition, market capitalization serves as a good indicator of where the firm fits in size-wise among its competitors or other publicly listed companies. Public corporations have different sizes. The market capitalization of firms trading on the Nasdaq may range from $2 million to more than $2 trillion, depending on when you read this book. If you were to make a list of all the publicly traded businesses by market capitalization for each market, it would be lengthy. To make research tasks easier, several groupings based on market capitalization have been devised to help narrow the list. Nanocap market caps less than $50 million, microcap market caps of $50 million. The advantages of investing in mid-cap companies. It's well recognized that the survival rate for new enterprises is extremely low. According to data from the U.S. Bureau of Labor Statistics, about 30% of new firms fail in the first 2 years after inception. Worse, 45% collapse during their first 5 years and 65% do so during their first 10 years. It's reasonable for investors to assume that medium-sized firms have successfully completed the high-risk phases of the startup and early market development lifecycle. It can indicate to investors that there is a lower level of investment risk associated with medium-sized businesses since they have proven longevity. Not always true, but the bigger size can often aid in the survival rate by allowing management access to more resources and business opportunities than they had early on in the company's existence. Historically, mid-cap companies have posted strong performance relative to their more popular large-cap counterparts. According to research conducted by S&P Dow Jones Indices, mid-cap companies, as measured by the S&P Mid-Cap 400 Index, outperformed the S&P 500 and the S&P 600 between December 30, 1994 and May 31, 2019 at an annualized rate of 2.03% and 0.92% respectively. Despite its strong performance, the mid-cap market is under-followed by retail and institutional investors across the different size categories. According to the research, mid-caps are also underrepresented in the mutual fund industry during this time period, 2003 to 2018. The lack of interest among most investors toward mid-caps implies that there is still plenty of room. Prospects for growth. The phrase small time has acquired a new meaning in recent years as the majority of businesses have grown, increasing their workforce to more than 1,000 individuals. The advent of formal business structures such as LLCs and corporations, along with the existence of investment clubs and private equity firms, has made it much simpler for small companies to raise capital from investors. Increased capital, whether from finance or existing assets, can be used to support future development by funding new lines of business, increasing the workforce, opening new offices, adopting modern technology, or even taking part in corporate actions such as mergers and acquisitions. Mid-sized businesses are looking for ways to raise funds from a variety of investors. More significantly, larger businesses frequently seek to acquire mid-sized companies as a method to expand. They acquire small and medium-sized firms in order to gain a competitive advantage at a lower cost than it would take them to make the adjustments otherwise. A tuck-in acquisition or bolt-on deal is a type of expansion in which a firm purchases another company. A buyout is an event that frequently comes at a significant premium to the market price and may be a catalyst for a substantial return on investment. Mid-cap equities are beneficial in portfolio diversification since they balance growth and stability. The disadvantages of investing in mid-cap companies. The journey to becoming a mid-cap firm is often difficult and lengthy. Years of hard work have gone into developing and nurturing the business, after all. In many cases, certain qualities or characteristics that were beneficial in one scenario can become drawbacks in another. For example, when a company grows, management styles that work well while it is smaller do not apply. As a firm expands, new kinds of competitive market pressures emerge. Demands from suppliers, investors, and employees change as the business expands. These evolutionary pressures are not inherently a disadvantage, but management reaction to them might be. It is the investor's duty to determine whether risk profile modifications are appropriate. Investing in mid-cap businesses has its drawbacks, including the fact that they aren't as well known as their large-cap counterparts. In many situations, goods produced by mid-cap firms are just beginning to gain household recognition. This implies investors will spend more time researching and analyzing a company's performance. Some types of investors just want to buy and hold a stock without worrying about keeping up with the latest news. Another disadvantage of mid-cap stocks is that they are more volatile than large-cap stocks. This is to be expected, as the shares of these companies are less liquid than those of larger firms. There is a greater chance that something will affect the share price of a mid-cap company, since these businesses are more dependent on a few products or services. Another disadvantage is that mid-cap companies are underfollowed by Wall Street analysts. This is because there are fewer analyst research reports published on these firms. As a result, there is less information available for investors to make informed decisions. Despite these disadvantages, mid-cap stocks have the potential to generate higher returns than their large-cap counterparts over the long run. These companies are often more nimble and can adapt to change more quickly. They also tend to be less risky, as they have a lower debt-to-equity ratio and are less likely to be impacted by an economic downturn. Mid-cap stocks offer investors the potential for higher returns than large-cap stocks, but they also come with more risk. These companies are often more nimble and can adapt to change more quickly. They also tend to be less risky, as they have a lower debt-to-equity ratio and are less likely to be impacted by an economic downturn. Investors who are not interested in learning about or analyzing the mid-cap portion of the market may wish to invest in one or more of the targeted exchange-traded funds that are now available. There are several ETFs dedicated to mid-sized companies. For those who want to concentrate on factors such as growth, value, dividends, or even environmental, social, and governance screens, there are ETFs available that track companies of this size. Investors who are looking for individual stocks may find the following mid-cap companies to be attractive: Align Technology, ALGN, CrowdStrike Holdings, CRWD, Zoom Video Communications, ZM, Trade Desk, TTD, PagerDuty, PD. Despite these disadvantages, mid-cap stocks have the potential to generate higher returns than their large-cap counterparts over the long run. These companies are often more nimble and can adapt to change more quickly. They also tend to be less risky, as they have a lower debt-to-equity ratio and are less likely to be impacted by an economic downturn. Mid-cap stocks offer investors the potential for higher returns than large-cap stocks, but they also come with more risk. These companies are often more nimble and can adapt to change more quickly. They also tend to be less risky, as they have a lower debt-to-equity ratio and are less likely to be impacted by an economic downturn. The bottom line: the investing public is relatively uninterested in the mid-cap sector. Many investors are more interested in well-known big caps or the lucrative prospects of up-and-coming small caps. Because the mid-cap sector has moved beyond the risks connected with early business development, it is sometimes seen as less appealing. Nonetheless, factors such as strong performance, low debt, and increased dividend yields should not be ignored. For the long-term investor, mid-cap stocks offer the potential for both stability and growth. Do mid-caps outperform large caps? According to research by S&P Dow Jones Indices since 1994, the S&P 400 Mid-Cap Index has outperformed the S&P 500 and the S&P 600 indexes by an annualized rate of 2.03% and 0.92% respectively. Strong performance relative to other segments is often attributed to mid-cap companies being in the sweet spot of the market. Risks associated with early growth are lessened because businesses are more established. This means that mid-caps are often ripe for significant growth opportunities with a reasonable level of risk. Are mid-caps good candidates for M&A activity? Yes. Large caps are frequently interested in acquiring mid-cap firms because they seek to expand, but they aren't interested in building out a certain sector on their own due to cost or time constraints. A bolt-on acquisition, also known as a tuck-in acquisition, is a form of corporate merger and acquisition activity. Key takeaways: with a market capitalization of between $2 billion and $10 billion, mid-cap firms offer a distinct set of growth prospects with minimal risk. Mid-cap firms are frequently sought after by larger businesses wanting to diversify their holdings or grow through acquisition. Despite this, mid-caps are still neglected by both retail and institutional investors. And there you have it, folks. Share your thoughts down below in the comments. Remember to like and subscribe for future notifications.